Welcome to another episode of Mayhem's Macro Monday, coming to you on July 25th. What a busy week ahead we have between earnings, the Fed, and economic data, including consumer confidence and GDP. It is going to be a busy week. And I want to thank everyone for tuning in. If you like this video, please hit that like button and subscribe, and you'll be able to get more of this content as I put it out. And just be aware the whole video here is being put forth by TraderAid. You can visit us on the web, traderaid.com. We just launched a Discord, new plan offering called TraderAid Plus, so you get more real-time, high-frequency trade ideas, analysis, and engagement from the TraderAid team. Myself, Aisha, and Horst are all there. So it's a lot of fun, and we've been growing really rapidly, and we'd love to see you there if you aren't there already. But without further ado, let's talk some charts. First thing we have here is global growth optimism is hitting an all-time low. This is worse than it was during the COVID crash. It's worse than it was during the 2018 tightening tantrum, and worse than it was during the great financial crisis. So some would say that this is a contrarian indicator leaning towards bullish because people are less overweight equities, but also that they're very, 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 very bearish on the global economy. But I would say the one thing that we want to pay attention to in this chart is the turning point wasn't necessarily just when people got really, really pessimistic. It was also when central banks started to flood the financial system with liquidity. So you could say this is sort of a two-step process. We have the washout of sentiment. We have the washout of overweight equities positioning. We do not have the resumption of the liquidity spigot. And until we do, I don't think this is worth much more than just a glance. Next chart is from Bloomberg again, asking if the bad news is baked in. And I'm not so sure that it is. I think we could see further downward revisions to earnings. I think that it's a little bit of a question here as to whether or not we've seen enough of that. And I think this earnings season will give us a better idea as to what 2023 might look like with some of the guidance we're going to get. But quite frankly, the economy is headed towards a recession both here, but also abroad. There's a lot more weakness to come potentially as central banks continue to remove the lifeblood from the financial system and the global economy, which is this idea of lower and lower rates and a greater and greater abundance of liquidity. And when you have over 300% debt to GDP globally, you need those lower rates to keep growth going, even to keep the current debt loads sustainable. So I think that, while the suggestion is bad news baked in, question mark, I'd say no, not quite yet. Let's shift gears because we've got a lot of big tech earnings coming up this week. So some of these charts are pretty interesting. These are the top revenue sources for some of these large tech firms. You can see Google's got a huge amount of revenue from advertising, just a sliver from the cloud. Amazon's got a huge amount of revenue from e-commerce, but they have a nice chunk from their cloud, and they are the biggest cloud provider. Apple, consumer electronics leader, but services is a growing segment. Samsung's similar in that sense that they're a big consumer electronics company, but they're also a big semiconductors company. And actually, they're looking to invest over $200 billion in U.S. Semiconductor fabrication in the next several decades. And if that happens, it could be a very good thing for kind of onshoring some of this production. Then we look at Huawei, and we could see telecom is their big, big, big revenue generator, which makes sense. A lot of cell technology, towers, radios, other kinds of communication equipment, but they're also pretty well involved in consumer electronics, particularly in Asia. Meta, we can see they're pretty much all ads, which makes sense. And then Tencent, gaming and services. And finally, Alibaba, e-commerce and cloud. And they're another really big cloud company out there. And I somehow neglected to mention Microsoft, so let me just back up there and say, boy, oh boy, they are a big component of the software industry, one of the biggest, but they also have an increasingly large chunk of the cloud. They are growing faster than Amazon now, and while Amazon has a lot more market share, Microsoft's growth rate suggests that they are eating the market share of smaller competitors. And how profitable is Amazon really? Well, if you look at their cloud segment, it's immensely profitable. E-commerce, it's not quite as much. But still, Amazon is a juggernaut. And one of the advantages that they have is they can kind of go into any industry and disrupt it. Bezos's mantra, your margin is my opportunity, is something that's been realized in a lot of the forays that this company has undertaken. And market share of cloud services, we can see it again here. Amazon is 33% of the global cloud. That's huge. Microsoft is 21%, Google is 10%, Alibaba 6%, IBM 4%, and other, quote unquote, is about 18%. Companies that are too small to really lump into this graph. You could think of them like DigitalOcean, for example. And big tech's share of price total return since IPO. Can you believe Microsoft there at 360,000? 428%. Just mind-blowing. But Amazon and Apple, not too shabby, 145,980%, and Apple at 138,830%. Google seems to be somewhat paltry in comparison, but they also got brought to market at a higher valuation than their peers. The global smartphone market is shrinking a little bit. We're seeing shipments fall year over year. That's probably not a good sign for some of the aforementioned companies, particularly Apple, depending on how this may impact them. Obviously, this chart's not broken down by the company. I would be more interested to see that data at a granular level. But I still think this is somewhat cause for concern because we can say that, the refresh cycle on smartphones is probably starting to slow a little bit. If your phone still works, you don't necessarily need the fancy new candy bar phone that comes out in 6 months or a year. People are probably a little more willing to wait a year and a half, 2 years, or even when their phone starts to become obsolete to replace it. And that will slow the sales cycle, right? Because if people aren't replenishing as frequently, then there's going to just be less phones sold. China is dumping treasuries, and they are below $1 trillion in holdings for the first time in just about 12 years here. And it's interesting because this has been a year where Treasury performance, the bond market, has had the worst start in about 40 years. And not only has China been dumping, but so has Japan been dumping their holdings. And so when you see, the foreign counterparties aren't stepping up the bid, the Fed is content to let these things roll off its balance sheet, that does put some additional pressure on the Treasury market. And I would be inclined to say that some of these foreign counterparties kind of saw that writing on the wall and said, let's get out of this, let's get ahead of this before quantitative tightening. And there's other reasons too. China's economy is struggling. They probably need to raise some capital to be able to distribute and stimulus at home. But nevertheless, this is not a huge vote of confidence for the Treasury market, and the less foreign counterparty bids there are in subsequent auctions, the more we might see some volatility and upward pressure in rates. Though at this point, I think what we really want to be watching in this market is whether or not the so-called recession trade takes favor, and that would be where bonds really start to get a strong bid and commodities get faded. Finally, last but certainly not least, bear versus bull markets going back to 1926. The average bull return is 162% at the index level, with just over 4 years, about 4 years and 3 months. It's the average duration of a bull market. Meanwhile, bear markets last just under 2 years at 20 months, with an average negative return of minus 41%. So something to keep in mind, the current bear market, we're down about we're down 24%, right? And that's over a duration of 5 months. So that would suggest that there's both more downside and a longer duration possible with this bear market. And what often turns bear markets after, let's call it, the 1990s era, is going to be Fed intervention. It's going to be a change in policy. And we have the opposite. We have an aggressive Fed that is hiking into a recession because of inflation and really presumably an asset bubble, multi-asset class bubble, in fact, in bonds, stocks, real estate, crypto, all that, which is still a bubble. And I think that, part of taking prices back under control is popping bubbles, is subduing inflation by destroying the wealth effect, but also destroying demand by increasing the cost of capital, draining liquidity from the financial system. It will induce a recession. It will create a bear market every time they do it, including this time. So I think that's something that's important to keep in mind, because I know a lot of folks out there keep calling for bottoms, and of course anything can happen. But when we look at probabilities, when we look at statistics over the last, say, 30 years, it's much more likely that the market is going to bottom when the Fed starts to ease, rather than just because there's been some sort of exhaustion or sentiment washout or otherwise. Now, we can get interim bottoms, which means you get a violent counter trend rally. A lot of people start to believe that the bear market is over and the bull market has begun. So you get shorts covering, get longs, going longer or even adding leverage. And then typically you get a exhaustion of buyers. There's no one left to buy. You get a lower high, and then sellers come in and they start to sell down the market. Buyers get scared. They add to that selling. Shorts get more aggressive. They start to sell into it, and you get a lower low. And that's been the pattern for all of 2022. I'm not so sure it's about to end here, but we could still have some legs in this counter trend rally. So let's see what happens in the week ahead. And I want to thank everyone for tuning in to Mayhem's Macro Monday. Really appreciate it. Again, if you enjoy these videos, like and subscribe. You can hit the little notification bell. I put a stream on pretty much every day with Bookmap and MotiveWave with the Order Flow Labs tools showing the S&P 500 futures. It's become pretty popular. It's a lot of fun. And also, I'd be remiss to not mention again, TraderAid.com. We just launched our Discord there. I think a lot of folks would like it, so you can check it out at TraderAid.com/Discord to learn more. And as always, feel free to ask questions and leave feedback in the comments. Thanks again for tuning in.